All right, let's get right into it. Today, we're doing a deep dive on a really interesting investment case. One where what the market thinks is happening and what the data shows is happening, well, they seem to be two very different things. So let me just ask you this. What if you could buy a market-leading company? I mean, a true powerhouse. It's basically the mission control for thousands and thousands of businesses, but you could get it at a big discount? That's the question at the very heart of what we're looking at today. And it all comes down to this number right here, $92. Now, according to the analysis we're digging into, this isn't just some random price on a chart. No, this is being flagged as a critical entry point, one that could potentially unlock some serious value for investors with a long-term view.
So for anyone who's not super familiar with them, Paychex is an absolute giant. They handle all the messy, complicated, and let's be honest, super annoying parts of running a business. We're talking payroll, HR, benefits, all for more than 770,000 clients. This makes their services what you call sticky. Once a business is using them, it is a huge pain to switch.
And that brings us to the core thesis of this whole thing, the idea that Paychex is an undervalued dividend powerhouse. It really seems like the market is fixated on one part of the story, but if you look under the hood, the numbers suggest there's a whole lot more going on. So you might be asking, why the cheap price? Well, the big fear casting a shadow over the stock is this worry about a slowdown in hiring for small and medium-sized businesses. And you know what? It's a legitimate concern, and it's what has pushed the stock price down to near its 52-week low. But, and this is a big but, this is exactly where the story takes a fascinating turn. While the market is reacting to that scary headline, a closer look at the company's actual numbers paints a very, very different picture. A picture of real strength and, potentially, a big opportunity. Okay, let's talk valuation. The PE ratio, that classic tool for seeing if a stock is cheap or expensive, it's really telling here. Right now, Paychex is trading at a PE around 21. That is way below its own historical average, which is up around 27.5, and it's even trading at a discount to the wider market. This is one of those classic signs that a stock might be on sale. So what does that gap actually mean in dollars and cents? Well, if you look at the average analyst price target, which is sitting around $119, getting in at $92 implies a potential upside of over 29%. That's a pretty significant margin of safety. And here's what might be the best part. While you're waiting for the market to, wise up and recognize the company's value, you actually get paid. The stock is offering a forward dividend yield of a whopping 4.58%. If you're an income investor, that is really, really hard to look away from. And check this out. This isn't some shaky, unreliable dividend. We're talking about some serious quality here. We're looking at 12 consecutive years of dividend growth, capped off by a recent and very generous 10.2% hike. This puts Paychex firmly on the path to becoming a dividend aristocrat, which is basically the Hall of Fame for companies that consistently raise their dividends. Okay, so the stock looks cheap. It pays a fantastic dividend. But what about the future? Is this company just sitting still? Not at all. The analysis we're looking at points to three distinct growth engines that are pushing this company forward. So their whole game plan really seems to be built on three core pillars. First, making smart acquisitions that add real value. Second, innovating with AI and tech to make their products even stickier. And third, just using their super resilient business model to expand their reach. Let's talk acquisitions for a second. These guys have made some killer moves. For instance, one of their key acquisitions was a massive driver behind the 21% growth they saw in their management solutions segment. That deal gave them a much stronger presence in the super valuable mid-market. Then there's the tech. By weaving AI into their platforms and adding new, useful services like bill pay, Paychex, is basically making its whole ecosystem indispensable. You just can't leave. And it's also making them incredibly efficient. I mean, look at that operating margin of 41.7%. That is just wild for this industry. And it's not just us who think so. Wall Street is definitely paying attention. This projection from Seeking Alpha, calling for a nearly 15% compound annual growth rate over the next few years, that really highlights the kind of long-term potential these growth engines are fueling. But look, no investment is a sure thing, right? We have to be honest about that. To get a full picture, it's absolutely crucial we talk about the potential risks and the headwinds that Paychex could face. The biggest boogeyman is competition. I mean, the HR tech space is packed, but Paychex has a massive defense, a powerful moat, an 83% client retention rate. Think about that. Once a business is in their system, they almost never leave. That creates a huge, durable advantage. And the other big risk is, of course, the economy itself, the thing we talked about earlier. But Paychex has some built-in shock absorbers. They have a ton of different services, and they have a strong focus on more stable blue-collar industries, which helps protect them from the swings you might see in the white-collar world. So, after laying out the opportunity and weighing it against the risks, what's the final verdict from our source material? Let's tie it all together. This table right here, it's pretty much the whole story in a nutshell. The investment case stands on 3 strong legs. You've got a discounted valuation, providing a margin of safety. You've got a high yield and growing dividend for steady income. And you've got multiple growth drivers for that long-term upside. It's a rare trifecta: value, income, and growth. So when you put it all together, the conclusion from the analysis is pretty darn clear. The data strongly suggests this is a top-tier, industry-leading company that just happens to be on sale right now. And for investors with a long-term horizon, that makes Paychex a really compelling buy at this price. Which really just leaves us with one final question to think about. When you consider the solid fundamentals, that beautiful dividend, and the clear paths to future growth, could the market's current pessimism about Paychex be one of the biggest oversights out there right now?